Vitaliy Katsenelson, CEO of IMA and author of the new book, Soul in the Game, The Art of a Meaningful Life. Welcome to the show. It's great to have you on, Vitaliy.
Julie, it's my pleasure. Thank you.
Well, we were just chatting, and I know you've written a few books that were investing focused, and Soul in the Game, while it's not an investing focused book, I have to say, I think it's a must read for anyone in the investing community. It really surprised and delighted me in so many ways. So I encourage folks who are here watching or listening to pick up a copy. But, it's just really powerful about philosophy and kind of finding that meaning of life, and just an incredible read. So I just want to start there. But let's begin, Vitaliy, with your background, which is kind of how you open up the book, and you share a bit about your upbringing, some of the lessons. But for folks listening, can you share with us, your background?
Yeah. So today I live in Denver. I have a wife and 3 kids, and I'm a diehard value investor, and so I'm a CEO of IMA, which is a value investment firm. In addition to that, I write, and I used to be kind of embarrassed of writing because I thought people would not take me seriously as an investor because, he's the guy who writes. But today I kind of fully embraced it. I realized I'm a student of life. I'm a person who invests, who writes. But so I wrote, as you mentioned, several investment books, but I also write, articles, which are published, MarketWatch, Financial Times, Barron's, etc. But that's not what you're asking me. So what you're asking me, where did I get my accent? That's what you're asking me. And let me tell you this. So I was born in Russia. Actually, I was born it's kind of interesting. When I left Russia, I was not really living in Russia. I was living Soviet Union because we left Moscow basically in December 1991. At that point in time, Soviet Union was living in Soviet Union. Then literally months later, the Soviet Union ceased to exist. So I was born in Murmansk, Russia, and that's where I spent most of my, basically the first 18 years of my life. And then my whole family immigrated to the United States, and we lived in Denver since.
Got it. So you came to the U.S. 31 years ago, and you kind of share in the book, some of the things that surprised you coming from the former Soviet Union to the U.S., and even some of your perceptions around, capitalism, for example. Can you kind of take us back to that period in your life and, some of your encounters or realizations coming to the U.S. 30 years ago?
Yeah. So what's important to understand, when I was in Russia, I did not know a single person who owned their business. Every single person, even including the barber, worked for the government. So and so it was a command controlled economy, and with a command controlled economy, you get a very inefficient economy. And so, a lot of our stores, my parents were always worried about how they're going to feed us because the store shelves were always empty. You had to. The food was always meat. Meat, chicken, eggs were always hard to find, and we were given vouchers. For so many pounds of meat, per person per month. So if they were selling meat, you can only get so little, so much of that. So my parents were always concerned about, what are we going to eat tomorrow? But we never really went hungry, and so that was kind of. So I got used to that in Russia. So when I came to the United States, I went to the supermarket and I was shocked because there was just incredible abundance of food. And Julie, I got to tell you this story. So until I was 18 years old, I had Pepsi or Coke, actually in this case was Pepsi, once. And I remember how magical that experience was because very, very hot outside. And I'm Coca-Cola commercial, you can make this into a commercial because having that magical drink was such a incredible experience. Now, when I came to the United States and I go to the supermarket, I realized I can buy a gallon of Coke or Pepsi and it's very cheap. And so you know what I did for the next 3 years? I consumed more Coke over the next 3 years in my life in the United States than I did over previous. Like I made up for the 18 years of missing consumption of Coke. And the interesting part, there is actually some value in scarcity. And the value in scarcity is that when, like at the end of year 3, when I had a gallon of Coke a day, I was sitting at the Village Inn, and I had my third refill of Coke, and I remember how I could not taste it anymore. It tasted like water. I could not even taste the sugar anymore because I drank so much of it. And this is where I realized that we kind of, coming from Soviet Union, I, kind of having a lot of food and be able to drink Coke as much as you want sounded like a great thing. But there is some value in scarcity, and there is also downside in abundance. And that was a kind of very important lesson for me.
Yeah. What I love about the book too is just the way you find these analogies and stories, and you kind of can share lessons too. Just from like, you had never had a Coke or a Pepsi except for once in your life, and then just having too much of it. Yeah. I don't know if you still drink soda to this day. You were sipping, I think, a seltzer.
No, this is like, to be honest, this is bubbly. This has 0 calories.
Yeah, because I do know that you don't eat dessert anymore.
No, and I literally only drink Coke now when I go to see a movie. So I drink, like I stopped. So what happened was I was 21, I stopped drinking Coke, and now so the only time I have it now when I go to see a movie. So I drink Coke 3 or 4 times a year now, and I tell you, every single time I have Coke or Pepsi, I don't know why I keep going between Coke and Pepsi, like I'm gonna insult one or the other. But anyway, whenever I have a Coke, I have a soda, I enjoy it so much more because I only do so many, just so few times a year. Now this is basically bubbly water, so there's no sugar here. This is just 0 calorie,
Yeah, totally. You were talking, Vitaliy, about the notion of business when you were in the Soviet Union, like how that even worked. Like people didn't like have like their own businesses, government owned, and then coming here and kind of seeing the capitalist system. And for folks who don't follow you, like you're in the value investing world, which is a world I cover, or covered as a journalist, like the world of Warren Buffett and Charlie Munger and many, many value investors. And so you're in the investing community. You're investing in like what you see as great businesses. Let me ask you this, like, how did you get interested in investing or even, wanting to pursue a career in that field? What was that for you?
So, when I came to the United States, I had no idea what I'm going to do. And so I enrolled in university, and I was, realized I wanted to do something in business, though for some time so it's kind of funny when I literally changed major every few months. And this is like 1995, I think. And O.J. Simpson's trial was a huge deal. Like it was people don't remember this now, but at the time, even CNBC stopped their like normal programming after market hours. And after the market closed for 5 hours, you would have like everybody would talk about O.J. Simpson trial. That like when they say it was a trial of the century, it really was. Like every single channel probably had 3 to 5 hours of programming a day about the trial. And I was so exposed to that even for a little while, I contemplated about being a lawyer, but that didn't last very long. But I dated a lot of different majors when I was in college, and then nothing really clicked until I took a finance class. I took a finance class, and Julia, it was like a love of first sight. Suddenly, it's almost like everything clicked with me. It was very natural for me. And so I changed my major, and also at the same time I was working at an investment firm. They hired me, because of my computer skills. So I what I was doing had nothing to do with investments, but I was taking these finance classes. I started to talk to portfolio managers about what I was learning in school. And I was also lucky; those were very good people who wanted to talk to this, fresh immigrant of the boat about investments and stuff. And I changed my major for the last time to, basically finance. And I was lucky that maybe when I was 22, 23 years old, I was focused now just on finance.
Yeah.
So I finished my graduate degree in finance. I got my CFA. I even taught investments at CU Denver for a few years, for 5 or 7 years, I think. So
Yeah. You called it love at first sight. Like, talk to me about like that feeling. Like, how do you know that it's like love at first sight from a, career perspective?
it's very easy to test. I mean, if I basically was making kind of very little money, would I still want to do this? It's that simple. It's I am Warren Buffett, he says he tap dances to work. And I agree with that because, I drive to work, but I love it. And it's money is really such a secondary or third consideration. What's important about investing from career perspective, if you enter in this profession because of money, you're going to be miserable. Here's why. Because you'll be competing against people who are doing this just because they love it. And therefore, they will outlast you. They're going to, there's a famous basketball saying, you can't hire height. Well, you can't, like in basketball, right? So in investing, you can't, when you hire somebody, if the person doesn't have a passion, you can't, that person, that person is going to be miserable. And when we were hiring analysts for my firm, that's number one thing I was looking for passion, because they will outlast. Because there will be time when it's difficult, there will be time when it's painful, and if you're passionate about it, you get through that.
Yeah, I like the Warren Buffett tap dancing to work, and I can certainly tell that. Just based on your writings, that this is such a passion for you. And, speaking of writing, you mentioned at the beginning of this conversation that you're a little bit embarrassed when you first started writing. And I have to say, like, your writing is how I found you, and it's why I invited you on the show. And you've been featured in many, many, many publications. Like, talk to me about your journey as a writer. Like, why was it so embarrassing at first, and how did you kind of overcome that?
Yeah. So this is kind of a funny story. So I started writing in 2004. The Street.com at the time was, I think, probably the first financial website that actually had outside columnists. Okay. Before that time, the financial publications would never, kind of use outside columnists or market commentators to publish the content. And the Street.com was the first one to do this. And so when they hired me, they paid me absolutely nothing. And I'll be honest, they were overpaying me because I was horrible. And in addition to being horrible, I was so self-conscious about my writing. I was very proper. I was incredibly, incredibly boring. And in fact, I probably should go back and read, one of those articles that's 18 years ago, and just to see how much I progressed, because the bar was incredibly, incredibly low. But the thing is, I was young and I had absolutely no self-awareness. And literally a year later, a friend of mine, actually, it's kind of interesting, James Altucher, who also started the Street.com, he started writing for Financial Times. And I thought, oh, Financial Times, that sounds cool. So I said, James, can you introduce me to editor at Financial Times? He said, sure. James introduced me to editor at Financial Times. And I sent him my articles, and they said, sure, write for Financial Times. So I started writing for Financial Times. And Julia, I'll be honest, if today, there is no way I would have done it, because I would be so self-conscious, because I would have said, so you've been writing for a year, you sucked at it, and now you want to write for one of the most prestigious newspaper in the world, in the world. But I didn't, I guess, lack of self-awareness is, could be a good thing. So this is how I started writing for Financial Times. And little by little, I got more confidence. And also, I had this trick, which ended up being a huge deal for me. I would write these articles and I would send them out to my friends, who did not really ask to be sent those articles. But over time, this number of people who read my articles grew, and I started to get their feedback. And the feedback was very, very positive. And I'll tell you this, for a writer, having a feedback, that positive feedback, especially for starting writer, that feedback was very important because it gave me confidence to to push the boundaries of my knowledge or my comfort zone in writing. And over the years, I kind of started to branch out in adjacent topics to invest in. I started writing about life, classical music, parenting, and I'll tell you, like, that was to arguably I have the I have all the reasons to write about investing because I have degrees in finance, I have a CFA, I've been managing money for decades, but even venturing into writing about adjacent topics, even about parenting, having confidence is a huge deal. And this feedback I got from readers was instrumental for me to do that.
Yeah. I think like reading your book too, some of my favorite parts were, stories you would tell about your three children and like the lessons, learned from them. And like, I'm not a parent yet, but some of the ideas in there, I could tell you, I'm going to steal them. Like I'd steal like an artist, like taking your kids to buy, you have an unlimited budget on buying books. For example, you buy a book once a week for one of your daughters
and by the way, I stole this idea from Guy Spears' wife. So
I love it. That was great. But I just to kind of like go a little bit deeper on the writing, how has that changed or transformed you, as a person or also as an investor? 'Cause I keep having folks on the show, and it seems to me the ones who are writing, they talk about how it's really changed their life and their career. How do you think it's changed or impacted your career? And what do you think would have happened if you didn't put yourself out there or write?
Oh my God, I can't even imagine what my life would have been if I didn't start writing. It is by far the most important thing that has happened to me as an individual. Like right on the same, like right on par with parenting. Why? Why? It's very simple. I wake up every day at about 5 o'clock in the morning, and for 2 hours I write. My brain is kind of a scatterbrain, so my thoughts are kind of loosely organized, and this 2 hours a day of focused thinking allow basically me to access my subconscious, which is kind of this supercomputer where all my good thoughts are buried, and combination of kind of creativity and focus allows me to come up with ideas that I would not have otherwise. So if I have anything insightful to share with you, it's only because I've been, at some point I thought about this. At some point through writing. So, and if I do it every day, so I spend about 700 hours a year writing. And what it does, it's basically makes me a better human being, a lot more thoughtful. And it's increased my IQ tremendously, which I really needed a lot because I didn't know it wasn't very high. But also, it made me a much better investor because I spent a lot of time writing about investing, and just made me a lot more thoughtful. So that's the impact it had on me.
Yeah. A more thoughtful investor. You also share a story in the book. I want you to go back and share it too. How writing helped you deal with a painful period in your career as an investor. And I think I want to say, you can correct me if I'm wrong, I want to say it was around 2012.
2015, yeah.
2015, sorry,
yeah.
It was 2015.
Yeah.
You were on a trip with friends in Israel. They're having the time of their lives, seeing everything. And you were going through a painful period, and writing really helped you cope with that painful period. Can you go back and just share that experience and how that helped you?
So the 2015 was somewhat a difficult year for value investors because it seems like value was very out of favor. In addition to that, I made some, so it was difficult to begin with. I think the non-value stocks were doing much better, and I think I made a few mistakes. So I had more pain than it was a very painful period of time, and I found myself, I was in Israel this is November 2015, and in the middle of the trip, one of my stocks, it was not a huge position, but a good enough size position, declined by 80% in literally a day. And I was in tremendous amount of pain. And I had a lot of new investors, and those people never saw any positive returns from me at that point because I was, it was a down year. And it was very, very depressing experience. And so I'm on the street, and my friends are mesmerized by Israel. They're going to all these different wonderful places, and they're all happy. And I'm just dying inside. And what's interesting, until that point, like this is the first time in my life I was like truly, truly depressed. And one evening I came home, and I basically kind of wrote a letter to my client saying, here's what's happening. And so when I was writing this letter to clients, I was it's kind of the rational version of me came back. And I walked them through all the stocks that are down, and walking through the stocks, walking through the portfolio one by one, kind of, I realized, well, first of all, a lot of stocks are down, but their value, it's just because the price is down doesn't mean that the companies are worth less. In fact, a lot of them I thought would be worth a lot more. Yes, one or two stocks will never come back, but it's a portfolio of stocks. Therefore, on the portfolio level, we're still going to be fine. And there is a trick. Whenever you have a problem, whenever your friend has a problem and you talk to your friend, you're always going to sound very rational. But when you talk to yourself about the problem you're having, you're going to be a lot less rational. So Stoics have this concept is that when you try to, instead of talking to yourself, try to talk as if you were talking to your friend about your problems. And therefore, and that's going to make, then you'll be able to see your problems more objectively. And it's going to lessen, a lot of times you would find that it's going to lessen the gravity of those problems. And that's exactly what happened. When I wrote a letter to my clients, a more rational person of myself came back. And actually, I felt a lot better by the time I was done with the letter. And the amazing part, my clients were actually very empathetic to me. And we lost very, very few clients. And ironically, if I went to sleep like in 2015 and woke up in 2016, I would have woken up to great returns, right? So that's basically what happened.
Yeah. You mentioned that was the first time in your life that you truly felt like depressed.
Yes.
And you also you mentioned Stoicism, and I know that's an important part of your book and how you kind of live your life and investing, and you talk about this kind of Stoicism being like an operating system for life. Like, how have you deployed that to, deal with challenges? Like, have you had other periods where you felt that way, where you had to kind of use writing or more Stoicism to kind of get over it? Or
Yeah. So, let me tell you, the first time I used it without knowing it, the most traumatic experience actually I had in my life, and is I was 11 years old, and I lost my mother. She died from brain cancer, and I remember that was that was such a traumatic experience that I started to be afraid to lose my father. And I was always afraid that my father's going to die too. And that kind of what the Stoics would call it. At the time, I knew nothing about Stoicism. And, but the Stoics would call it negative visualization. So I visualized that my father would die. And that fear actually, I hate kind of finding silver clouds in my mom's death, but that was a silver cloud because it brought me so much closer to my father, and until now. This was almost 40 years ago, and I've been very close to my father with my father since. And I would go, my father and I would go on different trips, from Europe to South Africa. We drive to Santa Fe every year. I go to his house several times a week for breakfast. We go for walks. That's this kind of realization that that my father at some point will die actually made me value him so much more. That's a, and by the way, let me give you a less dramatic version of this. My daughter Hannah is 16 years old. She is in 11th grade in high school. The younger version of me would be kind of frustrated that I have to drive her to school every day, because instead of driving her to school, I could be going to work, and whatever I can be doing, reading 10Ks or whatever. But the stoic version of me, the newer version of me, realizes that Hannah in 2 years she'll be out of the house. She won't need me to drive her to school, and that I only have 300 something days of those one-on-one time I have with her in the car. So now every time I drive her to school, I look at this not as a chore, but as this incredible privilege. And when I'm in the car with her, I actually spend time with her. And actually I'm driving my youngest daughter too. So that changed, so the Stoics would call it reframing. So this combination of negative visualization and reframing. I took one situation, I reframed it from negative to positive, and suddenly what would have been what I perceived as negative now became positive. So that would be another example of kind of how I apply Stoicism.
Yeah, I like that the reframing and also recognizing mortality. And
yes.
And really using your time. I think you write a lot in the book about how we actually have a lot of time. It's just we don't all use it, or a lot of it's wasted. And really using it and investing it, spending time with those who really matter the most. How would you say Stoicism could apply to investing?
In Stoicism, there's a central concept called the dichotomy of control. What the dichotomy of control is basically Epictetus who. So let me just pause for a little bit. Let me talk about what is Stoicism. Stoicism is a 2,000-year-old philosophy that came from ancient Greece, and basically there are three Stoics that we still refer today because their writings survive to this day. That would be Seneca. Seneca, he was the true Renaissance man, 15 centuries before Renaissance. He was a playwright. He was advisor to an emperor. He was a senator. He was an investment banker. So that was Seneca. Then there was Marcus Aurelius, who was the most powerful person in the world, at least in the Western Hemisphere. He was an emperor of Rome. And then there was Epictetus, and Epictetus was a slave. So Epictetus has this framework, and it's called what we now call the dichotomy of control. And this framework is really what attracted me to Stoicism. And this framework says something very, very simple. And it says, some things are up to us, some things aren't. Okay, so far that doesn't sound so exciting. But when you discover what's up to you, that's what really gets interesting. You realize that what up to you is basically your values and your actions, your behavior. Everything else is not up to you. Okay, when you drive into work and every single light you hit is the red light, that's not up to you. What's up to you, I guess, is how you perceive this, number one, but it's also how you react to this. When you're at the grocery store and a clerk is rude to you, that's not up to you. You should not really expect to go through life and expect that everybody is going to be smiling and kind to you. That would be just naive. But what's up to you is how you react to this. Now, if you think about investing, okay, especially value investing, what is not up to you, what's up to you is your process, is how you analyze companies, what kind of decisions you make. What's not up to you is how stock market is going to value those companies at any point in time. Okay, or how it's actually not how to value, how it's going to price them at any point in time. And this is where value investing and Stoicism have a lot in common, because as an investor, you focus on your process and you try to improve it, knowing that in the short term especially, you have so little control over outcome.
I was just taking notes because I was like, I really like where you're going with this, the dichotomy of control and how it applies to the world of value investing. I would love to just kind of ask you right now, like, what is kind of your assessment or your views of like value investing today? I mean, when we were talking about when we went back to 2015, how it was a little bit out of favor at that time period when you had the more painful experience. A lot of turbulence in markets today. What do you make of the landscape as it relates to value investing?
I'm incredibly excited. I feel like I'm going to paraphrase our ex-president. High interest rates made value investing great again. Because what happened that when interest rates are low, when interest rates are low, the common sense, like when interest rates are low, they create a lot of bubbles in many different places except one place, common sense. The common sense kind of thrown out the window. And a lot of companies are valued on their stories. So a lot of companies would be owned on the earnings they're going to have in 2040, and which is fine because the market justifies it, because if interest rates are zero, earnings in 2040 worth almost as much as they worth in 2022. Now, and companies can basically can burn a lot of cash, not focus on cash flows. Okay, however, when interest rates go up, suddenly the common sense start to come back, and suddenly the quality of your decisions start to matter. Because before that, the more aggressive you were, the more speculative you were, the more you were the richer was your imagination, the more money you made. The high interest rates, I feel like, put the end to it. So now stock picking actually is coming back to life again, and actually the quality of my decisions actually have an impact on our portfolio, like on our performance, I'm very, very excited.
Yeah, no, it's interesting. Can we just, I want to hear a bit more and explore a bit more. So do you think it's like the last decade plus of, super low rates, easy money printing that kind of made it a difficult time before for value investing? It was just like the growth stocks were more favored. Just want to hear more on this.
Yeah, sure. So if you look at a lot of technology companies, they basically focused on growth and growth at any cost. And a lot of times, and I'm looking, there are a lot of these companies now down 70, 80%. And as an investor, as a value investor, I am very excited to look at them to see if I find something interesting there. And a lot of them are great businesses, but what I find, despite them being down 70%, a lot of them are still, number one, they were valued. But then, as you start looking below the surface, you find that the revenues went up a lot, but the expenses absolutely outpaced revenue growth by a huge margin. These companies, and what's difficult when you are only focused on growth, and when all your competitors are focused on growth, especially if you're in Silicon Valley, because there is a relatively limited talent pool of how many engineers you can hire, right? What starts to happen, you start pushing prices of engineers higher and higher. You have to give them more and more stock. I was talking to somebody who works at Facebook, and he was telling me how originally Facebook was gonna spend maybe $1 billion on the metaverse. Now it's on track to spend $15 billion. And the quality, I would argue, the quality of that spending is probably incredibly, incredibly low, because you just have to, they were paying a lot of money for almost anybody who can fog a mirror, and hold a keyboard. So that super high growth was not actually very healthy. And as now things normalize, and you're going to already start seeing this, you're going to start seeing layoffs, in Silicon Valley. And by the way, that's unfortunate, but it's probably good for these companies in the long run, because they get to get rid of a lot of, they get to become more efficient, get rid of a lot of fat. And at some point, these companies actually will become a good business, kind of good investments. and the cost structure will be, will be very different. They will stop, like a lot of these companies today giving away 10, 15% of the company every year to their employees, which is just, which is like completely insane. It's very difficult for stock to be a good investment when you give away 10 or 15% of your shares to your employees every year. So suddenly when interest rates are higher and when the access to capital becomes more difficult, companies that generate cash flows and that don't rely on the capital markets become more and more kind of valuable. So that's what's basically happening.
Yeah. Like when there's an abundance of capital, they can kind of throw it at anything and anyone. And it kind of sounds to me like maybe, there's a lot of talk right now about like tech layoffs, for example. But could that also be I don't know what you think of those. Would love to hear your thoughts there, but maybe just a sign of maybe there's more common sense coming back now that we're kind of out of the high growth phase, if you will.
It's kind of interesting. So you and I were talking about abundance in the beginning of the conversation, abundance and scarcity. Mm-hmm. Like my scarcity experience in Russia and abundance I experienced in the United States. And there is I don't want anybody to go through what I went through, the scarcity I went in Russia. But, so the extreme of scarcity is bad. The extreme of abundance is bad as well. So when interest rates come back to a semi-normal level, I think the market will come back to kind of Goldilocks of combination between scarcity and abundance. And yes, a lot of these companies are going to have to lay off a lot of their employees. They will be. Somebody asked me what I think about this quiet. What is it called? It's quiet quitting, right? Is that
quiet quitting? Yeah, there's this notion of quiet quitting.
Yeah. I'll tell you this. I know exactly how it's going to end. It's going to end with loud firing. Because if when this company when these companies are drowning in cash, and this and the capital is readily available, and investors are willing to pay more and more for lack of earnings or for growth, nobody cares about this. But when they have to suddenly produce cash flows, you start looking at people who work for a company and you say, is this the person I want to keep? So suddenly, person who quietly quit, you realize, actually, I should just fire that person. So I think these companies, they will be like we will be going through a kind of a version of .com 2.0 bubble. So we kind of, a lot of people would push me back on this and say, yes, but the companies that were in the kind of bubbly at the end of 2021 are much better businesses than kind of the ones that we saw in 2001. And actually, I think that would be a fair argument, except the valuations were so high that even there, like in like last year, that even after they're down 70%, they're still expensive. So I think the way usually these bubbles work is that there will be a period of time when nobody will want to touch technology company, and their valuations will get insane on the other side of it. They'll get too cheap. And so I'm kind of looking forward to it. Yeah. Because a lot of them are good businesses. They have good business models. They were just undermanaged.
Mm-hmm. You mentioned .com bubble 2.0. And I suppose you probably were managing money in the first .com bubble. Can you just quickly explain what do you mean by that? Because I had a guest recently he kind of analogized this period to that period as well recently. That was the Brent Donnelly episode for folks who are watching or listening. But can you explain that a bit more, this notion of a .com bubble 2.0 and maybe the similarities you see?
Yeah. Okay. So a couple observations. There were three types. I'm going to generalize, but there were three buckets of companies, maybe four. I'm going to identify four buckets of companies that got overvalued in 2001 and get burst in 2001. Number ones were kind of the obvious ones, kind of the pets.com, right? Companies that were just didn't really have a good business model, but they were internet companies, and those declined and never came back. Then there were second group, I would call them kind of the Amazon, the internet companies that actually had a good business model, but were still overvalued, like the eBays, the Amazons, right? They still declined, but those were good businesses. So they came back, and 15 years later, they were making new highs. Then the third group of businesses, I would put companies, technology companies that have benefited from the bubble in the technology spending. And I would put companies like those were real businesses, but whose revenues temporarily benefited from this unlimited amount of capital that went into buying anything technology related. I would put companies like Cisco, or Dell Computer into this category. Those declined less than the first two categories, and those came back a few years later. And then the last category would be kind of super high quality companies, completely unrelated to anything technology or .com related, that were just high quality companies and got overvalued. Like I would put Johnson & Johnson or Walmart into this category. Okay. Now, if you bought ironically, when we think about the .com bubble of 1999, keep talking about we think about the Pets.com, but even company like Walmart was trading, I forget it, 50 times earnings. And here's the irony of this: if you bought Walmart in 1999, I think it took you 18 years to make your money back. Some insane, like a long period of time. If you bought Qualcomm, which I would put it in the category of a third category, kind of high quality companies that benefited from technological bubble, that company, their revenues grew 15-20% a year, earnings grew 15-20% a year for next more than a decade. And that was an incredible business because that was a wireless company at the epicenter of kind of wireless transformation, right? But the stock was so overvalued, it took a long time for people to make the money back because the price to earnings was so high. So this is kind of what happens in the bubble. You have bad companies that get overvalued, and you have good companies get overvalued. And as a result, on the bad companies, you lose money and may never make them back, like Pets.com. On the good companies, it may take you a decade or longer to get your money back because they were so expensive. So I think in this during this bubble, we saw a lot more of companies in a kind of a technology space that were great businesses that were insanely overvalued. And let me see, and there was a lot of what I'll call bond substitutes, like the Coca-Colas of the world, like, that companies, like, because interest rates were so low, like now I'm talking about the latest bubble, because interest rates were so low in 2001, 2002, early 2002, people were buying Coca-Cola because it has a yield of 3.5%, and that yield was greater than whatever Treasury was paying you. And people's argument was, well, Coke is not going to go anywhere. Its earnings will be higher, not lower, 5 years from now, and therefore dividends will probably go up a little bit as well. And therefore, 3% dividend yield from Coke is better than a 10-year bond. That's why I'm going to buy it. What they miss in this logic is that when interest rates rise, Coke, when you basically buying Coke as a long-term bond, when interest rates rise, Coke price will behave like a long-term bond, and Coke should not be trading at 25 or 30 times earnings. Actually, I think it's trading at 30 times earnings. Coke should be trading. This is a company that's actually hasn't grown earnings in a decade or more, and so therefore it should be trading maybe at 15 times earnings. So the road from 50 to 30 is it's 50% decline. So yes, you get to keep the 3% dividend a year, but your capital declines by half. So this is kind of that's kind of my analogy. That's how I would compare the 99 to 2021 market.
Yeah. No, it's so interesting to hear you explain it. You're talking about, eventually, like, the tech sector could be really interesting for someone to look at from your perspective as a value investor. Yeah. So does that mean some of these stocks that were considered growth stocks, they can suddenly become value stocks?
Absolutely. What is a value stock? It's a company that's basically undervalued. That's all it is. So what I remember vividly from 2002, nobody wanted to touch kind of X.com's companies because they were so toxic. So many people lost so much money on them, right? But that's what creates an opportunity. So I'm building a watch list of all this, kind of .com 2.0 stocks that I'm kind of researching little by little every day, because at some point they will become so cheap that I'll be in the kind of value investor's paradise. I'll be buying companies that that have a potential to grow earnings at a very fast pace, that are much better managed now than they were before, because now they have to generate cash flows, and I'll be buying them at a cheaper price, like at bargain basement prices. That's my kind of value investor's paradise right there.
Yeah, value investor's paradise. We're just talking about the markets, but I just want to get your take. You're talking about high interest rates can make value investing great again. How about your view on the impact higher rates could have on the economy? What is kind of your more macro view?
I just wrote a loan client letter, and I just published it in 2 parts. In the first part, I talk about the housing market, and I would argue that it's almost again, I'm not an economist. I'm just a value investor. I'm a person who analyzes companies, so I rarely have an opinion of what the economy is going to do next. But at this point, I think the numbers point that we're going to have a recession. And when you say what numbers, just housing market, what's going on in the housing market. And so, Julia, if you look what happened from 2019 to 2021, 2022 in the housing market, housing prices went up 37 to 40%. Actually, it was a 37% increase from 1999 to 2019 to 2020 2021. In 3 years, almost 40% increase in prices, which is insane. But the affordability for a while has not really changed, because the 30-year mortgage went from 4% to 3%. So average homeowner in the United States was spending about $16,000 a year on the mortgage, and that hasn't changed because the rates declined. So the prices went up, but the rates declined. So that wasn't really impacted. So today, median house price in the United States is $440,000. At current rates, if somebody were to buy a house and they put 20% down, their mortgage would cost at current rates about $30,000 a year. It's up from 15 to 30. Now, let me just put this in a proper context. A median American makes today about $75,000 a year, which is roughly about 60, slightly plus $1,000 after tax. So in other words, they used to spend a quarter of their after-tax paycheck on the mortgage. Today, if they buy a house, that would be half of the paycheck. But while we have high gasoline prices and higher food prices, so the consumer is attacked today from different directions. It gets worse. For affordability to come back to, let's say, $15,000, for the housing affordability to come back to $16,000 a year, the housing prices basically have to decline. I think it's almost 40%. So in other words, anybody who bought the house after 2012 would be losing money on the mortgage, on the house. So average American today, so the median house price, again, $440,000. Median mortgage is about $260,000. So you have about $180,000 of equity on the median house. Well, that equity would get completely wiped out. When that equity is wiped out, it doesn't just impact the consumers' ability to borrow against the house. It also impacts their psyche. It impacts their confidence. So so I look at this, and it's almost like I don't see how we can escape a recession. It's not 100%, but it's a very high probability that we're going to be in recession. Now, you can argue that we already been in a recession for the first 2 quarters of the year, right? Because we already had 2 negative real growth in GDP in the first 6 months of the year. And kind of the government and economists said, well, yes, you're right, but unemployment was so low, and we had so many one-time issues after this pandemic that we were really not in a recession. And I'm fine with that. But today we have unemployment 3.3%. It's very unlikely that it's very likely that 6 months or next 12 months, unemployment is going to be much larger. And therefore they're going to be in a true recession where the economy will be declining and unemployment will be going up.
Wow. So what I heard you say is basically anyone who would have purchased a house since 2012 would be underwater on their initial purchase. And that
it gets worse. Let me add one point, because it gets worse. So let me tell you where it gets worse. So if you bought a house, if you own a house today, almost every American over the last 10 years refinanced their house, and they're probably paying maybe 3% mortgage, 2, 3, or 4% mortgage on the house, the interest rate. If you bought a house, so if you own a house and you want to move 3 doors down, in a house that costs as much money as your house, as your current house, because interest rates, mortgage rates today are over 7%, you'll be paying about $10,000 more for your mortgage. That's 15% of your income more. You'll be paying more for the same 4 walls, same 2.5 kids and a dog, just because you moved 3 houses down. That means, and if you already see this, that they're basically, the real estate market is almost dead. There are no transactions right now for that reason. Yeah.
And how might that impact an investor, like a value investor? Like, you're going to think about businesses that are going to be much more recession proof going forward. How does that impact your framework?
Yeah. So we are today as a firm, we have almost no exposure to consumer. We are basically making an assumption that no normal recessions lasted in the past, about 18 months. We're basically assuming that this one might last longer than the ones in the past, because of the kind of Federal Reserve and the government policies, we haven't really had a recession since 2008. So we're overdue for a recession, and it's probably going to be a longer one than we had the one in the past. So we have no exposure to discretionary spending, and we don't own any companies that have any kind of rely on discretionary spending, or whose kind of business is tied to the health of the economy. And another thing we're doing is basically we also, and it gets more complicated, but I think geopolitical situation globally today is very shaky. So we own a lot of defense companies, as a hedge for.
Yeah. We kind of started this conversation with your backstory and kind of your journey coming to the U.S. just over 30 years ago. And I know you've written about this more recently, and I've read a bunch of your essays, and I just kind of want to hear your views on America today and, some of your concerns or worries, because we often hear about, the division in the country. What's kind of your viewpoint?
Yeah, no, I think America became a lot more tribal. When I came to the United States, it didn't matter if you're Republican or Democrat, you could still have a civil conversation. Today, it's very difficult to have a civil conversation with somebody who belongs to opposing party. In fact, I read a number somewhere, and I'm going to butcher it, but and it goes both ways. But basically, 70% of parents from one party would not want their kids to marry somebody I'm going to make it up. 70% of Republicans don't want their kids to marry Democrats, and vice versa. The country became a lot more tribal. It's very difficult to have just a kind of a normal conversation to discuss issues without people getting angry. So it's I'll be honest, I like the country I found more than the country that I see today. There's America has changed for the worse in the last 30 years, but let's put this in a proper perspective. The gap between America and the rest of the world was so wide, that it's not, we have our problems, but it's so much better, still better place to live than anywhere else in the world. So I'm not going anywhere.
Yeah, well, no, certainly not. But I mean, maybe even applying some of these frameworks, mental models, like, what do you think what would like kind of help here? Is because it feels like, you've written about this. It feels like there's a lot of, as you put it, self-censoring. People are afraid to kind of speak their minds.
Oh yeah, no, and I found myself doing plenty of this. So I'll give you an example. I just wrote this essay about about student loans. Okay, and I was so when the administration came out and they wanted to do the student loan forgiveness, I was gonna write about this, and I found myself that I almost did not want to write it because I knew I'm gonna upset a whole bunch of people. But then I realized, you know what? So what? I think it's a very important topic. I think what I have to say may add value to a conversation. So I wrote a very kind of what I felt was non-political essay, basically explaining that student loan forgiveness is a very slippery slope, because what may happen at the end is that, by the way, this door was open, during financial crisis, right? This is what kind of the argument used today. So the Wall Street pigs get bailed out during financial crisis. Now let's bail out the Main Street by doing student loan forgiveness. But what was interesting? I was thinking about it when my wife and I got married 22 years ago. My son was born when 21 years ago, and I remember I was not making much money then, and my wife was going to school, and so it was kind of single income family, and I remember even though we didn't make much money, I was saving for my son's education. And the interesting part about this, that it's very difficult to get for somebody to get empathy for me today, because I'm a very successful kind of person. So, but I'm not talking about myself today. When we were putting $2,000 or $3,000 a year for my son's education, in 2002, that was 5 or 5% of my income. That's a vacation we give up because we want to make sure our son goes to college. That's another car we postponed buying for many, many years. That's that's how much of restaurants we didn't go to because we were saving for his education. And so when you basically start doing student loan forgiveness, you're telling the younger versions of me, not me today, but younger versions of me, you don't need to save. The government will always pay. You don't need to save for your future, for kids' college. The government will take care of it. But the problem is, so that's one problem. But then it gets worse. What's going to happen is this. What about a person who doesn't have a student debt, but owns a house that's now upside down? Well, you just bailed out a whole bunch of people who had student loans. What about people with mortgages that are down? Let's bail them out. Okay, so we just bailed out those people. But what about a plumber who didn't go to school, so no student loan, and rents an apartment, so doesn't own a house? You didn't bail them out, but that person now has a lot of credit card debt. Well, so since you already bailed out previous two groups, now they have to bail out this person, and so suddenly, little by little, if we keep doing this, we're going to become just a banana republic like Soviet Union was, where basically a larger, so what's interesting, if you look at the difference between Soviet Russia and United States, okay, in Soviet Russia, nobody owned the business. The government owned businesses. In the United States, you have a free market, and the role of the government historically, especially if you look at like 80 years ago, was very, very small. Every time you raise taxes, you make government larger and larger. And what's going to happen at the end, you're going to reduce a reason for somebody to work. If 80% of your income gets taxed away, that person will not be waking up at 6 o'clock in the morning or 5 o'clock in the morning, like trying to start a business that may or may not succeed. Because if that business succeeds, the government will take 80 or 90% of it. So what's the point of, giving up those hours with your daughter or your son when they're little to try to build a business? If you succeed, 90%, 80% of this money is going to go to the government. If you fail, you basically going to incur all the costs of failure. So anyway, so that's kind of the point. Is this? That was my essay, and a lot of my folks at IMA, at my firm, argued that I should not publish it, but I did publish it, and to my surprise, the feedback I received was very balanced. So, a lot of people agreed with me. Some people didn't, but it was a very kind of polite and respectful discourse. And I think this is what we need. We need to be able to have a conversation with somebody who you disagree with and do it in a way that you both can learn. And I think that's what kind of has changed over the last 20, 30 years since I came to the United States.
Yeah, it's what it means to be a student of life, too, and have that civilized discourse. But like real quick, is when you were kind of explaining this essay you put out, is it like does it create like a massive moral hazard, or put us on a path more towards socialism?
No, that's great. That's exactly right. What you're doing, listen. So this whole intention of helping other people, it's very noble, right? Like, well, what we're trying to do is trying to help other people. But there are second and third order effects. You're absolutely right. You are creating moral hazard. You're creating a slippery slope. You are creating incentives for people not to save. And also, by the way, when you forgive those student loans, it's you basically saying, here's what you're saying. You're saying our kids and our grandkids are going to pay for this, because that doesn't go away. Somebody still has to pay that, right? It's just you are, the person who went to college and incurred this debt. Now, kind of the debt goes from this person to our next generation. So the generation, a lot of them are not even born yet.
Well, Vitaliy, I've really enjoyed this conversation. Loved your book. Loved your book. I want to just pass it back to you. Can you share with folks where they can find you, where they can read your essays, pick up your books? I'm just going to pass it back to you now.
Sure. No, thank you so much, Julia. You're such a great host, by the way. Thank you. So the Soul in the Game, they can find on soulinthegame.net, and they can buy it at any bookstore, whatever. But if you want to learn more about the book, and more importantly, since the book came out, I already wrote 4 new essays, 4 new chapters, and you can get those essays absolutely free on soulinthegame.net. That's number one. I have a Substack, and if you just put my name, vitaliy.substack.com, you can just subscribe to my articles. They're absolutely free, no charge. And those are probably the easiest way to do this. Just, on a Substack, Vitaliy, Vitaliy .substack, or just go to soulinthegame.net. And by the way, you can subscribe to my articles there too.
Excellent. Well, Vitaliy Katsenelson, author of Soul in the Game and CEO and CIO of IMA, I thank you so much for joining us and just, being so generous with your time today. Thank you again.
Julia, thank you.